Hello everyone, welcome back to our YouTube channel Akib. TJ. What if I told you that some of the biggest banks in the world collapsed almost overnight? Trillions of dollars disappeared, panic spread across global markets, and it all began with a US housing market boom. Today, we'll dive into how this financial crisis started, how banks collapsed, and what the worldwide consequences were. The growing risk in the financial system. In the early 2000s, the U.S. economy was booming. Banks offered loans at low interest rates, and, crucially, they began giving mortgages to people with poor credit or low income, so-called subprime mortgages. At first, home prices kept rising, and everyone believed this boom would never end. The collapse begins. But by 2007, cracks began to appear. People started defaulting on their mortgages. Home prices fell, and suddenly, banks realized their assets were worth much less than expected. Confidence started evaporating, major bank failures. Then came the breaking point. One of the largest investment banks in the world, Lehman Brothers, filed for bankruptcy in September 2008, still the largest bankruptcy in U.S. history. Around the same time, Bear Stearns collapsed earlier and was sold under pressure. Merrill Lynch was forced into a takeover, and insurance giant AIG needed a massive government bailout. The entire financial system was unraveling. Panic spreads through the system. Trust between banks evaporated. Lending froze. Businesses couldn't get loans. Stock markets crashed worldwide. People rushed to withdraw money from banks. It was a full-blown panic. Another important dimension of the 2008 crisis was its long-term impact on inequality and wealth distribution. While millions of ordinary people lost jobs, homes, and savings, financial markets eventually recovered much faster than the average household. This created a widening gap between those who owned assets, like stocks and real estate, and those who depended mainly on wages. It also sparked public anger and movements demanding accountability from big financial institutions. The crisis didn't just reshape economies, it reshaped how people viewed fairness, opportunity, and the role of the financial system in society. Global repercussions. This wasn't just a U.S. problem. Banks in Europe were hit hard. Global trade slowed down. Millions lost jobs. Economies fell into deep recessions. It became the worst financial disaster since the Great Depression. Government intervention. To prevent total collapse, governments stepped in. The U.S. launched massive bailout programs. The Federal Reserve injected vast amounts of money into the system. Interest rates were slashed to near zero. These measures helped stabilize banks, but the damage to trust was deep. The 2008 bank collapse taught us one critical lesson. Even the largest financial institutions are not too big to fail. And when banks fall, the entire economy can come down with them. If you found this video insightful, like, share, and subscribe for more deep dives into global finance.